Look at your screen today. I mean, if you've been watching the markets at all, you've probably already noticed this massive anomaly lighting up the ticker tape.
Oh, absolutely. It is completely dominating the conversation.
Right. The company is Datavault AI Inc. Ticker symbol is DVLT. Because today, April 16, 2026, this stock didn't just, have a good session. It completely exploded.
Yeah, surging almost 20% in a single day is, well, it's chaos.
Complete chaos. The trading volume is off the charts. The stock is violently breaking through these short-term falling trends. And there is this, I don't know, this palpable, feverish buzz taking over the retail trading boards. But, and this is a big but, if you actually zoom out and look at the underlying mechanics of this company, the long-term signals are genuinely terrifying.
They really are. What's fascinating here is the sheer dichotomy, right? It's the ultimate financial Rorschach test.
Yeah.
You look at the tape today, and half the market sees this undervalued tech gem finally getting the respect it deserves. And the other half, they see a meticulously constructed trap waiting to swallow retail money whole.
Which is exactly why we are tearing it apart on today's deep dive. We are going to look under the hood of Datavault AI, the income statement, the balance sheet, the actual cash flow, and some incredibly suspect insider trading.
Yeah, we have to talk about the insiders.
Definitely. We need to figure out how a company can look like a rocket on the outside while the engine is seemingly falling apart on the inside. Now, obviously, we are dissecting the mechanics of the market here, so, we are not giving you financial advice.
Right, absolutely no financial advice, just intellectual debate.
Exactly. We're just trying to solve the puzzle of why this stock is behaving this way. And if you enjoy solving these puzzles with us, hit that like button, subscribe to our YouTube channel, and you absolutely must leave a comment below. We want to know, as we go through this data, whether you are buying the bull case or the bear case today.
Yeah, let us know. Because to really understand the sheer madness of today's price action, you have to realize that this company is essentially living in two parallel universes.
Okay, how so?
Well, the top-line revenue numbers they just reported are so high they almost look like a typo.
Right.
But their cash position, the actual money they have to keep the lights on, is so low it threatens the existence of the entire operation.
Okay, let's unpack this, because we need to start by grounding this in today's battlefield. The stock closed at 0.8375 cents.
Yeah.
That is a 19.63% spike in one day. But to put that in context, we need to look at the 52-week range. Over the last year, this stock has been as high as $4.80 and as low as 55.
Which is a massive drop.
A huge drop. So this recent surge is happening like deep in the basement of its historical price. The stock broke above its 50-day moving average today, which was sitting around 71 cents. But it is still trapped far below its 200-day moving average of $1.01. I know moving averages can sound like abstract math to some people, but what do those two specific lines actually tell us about the psychology of the people trading this stock?
Well, think of moving averages not as lines on a chart, but as physical layers of human emotion.
Oh, I like that.
Yeah. When the stock breaks above the 50-day moving average, it means short-term traders.
Yeah.
The people who bought in the last 2 months, they're suddenly in the green.
Right, they're making money.
Exactly. They feel smart, the momentum builds, and greed takes over. That's the bullish signal we saw today. But that 200-day moving average at $1.01, that is a ceiling made entirely of desperate investors.
Meaning the people who bought it a year ago at $4 watched it crash to 55 cents and are just praying for a miracle.
Precisely. Anyone who has held this stock for the last year is deeply underwater. So the second the price climbs back up toward $1.01, a massive wave of those long-term holders is going to sell simply to break even and escape the nightmare.
Just to get it.
Yeah, just to wash their hands of it. That creates immense downward pressure, which is why the long-term trend remains overwhelmingly bearish despite today's 20% spike.
That perfectly frames the battle lines we're seeing. The stock has a strong support floor sitting at $0.70. But looking up, immediate resistance is right at $0.85, which it almost hit today, and then a very tough monthly ceiling at 99, right before that psychological dollar mark. Meanwhile, the momentum indicator, the RSI, is sitting at neutral to slightly overbought, so the elastic band is stretched. But what blew my mind wasn't just the price. It was the sheer force behind it.
The volume was insane.
Right. We saw 90.26 million shares trade hands today. That is triple the average volume. Heavy buying shoved it from $0.84 just in the final hour of trading alone.
Yeah.
So who is coordinating a 90 million share buying spree?
Nobody. Nobody is coordinating it at all. And that is honestly the most dangerous part of this setup.
Wait, really?
Yeah, if you look at the institutional ownership for Datavault AI, it's effectively zero. It sits at 0.66%,
Wait, less than 1% of this company is owned by Wall Street.
less than 1%.
Yeah.
Mutual funds, pension funds, institutional hedge funds, the quote-unquote smart money that provides a stabilizing anchor for a stock.
Yeah.
They refuse to touch this. They are completely sitting on the sidelines, which means today's 90 million share frenzy is 100% retail driven.
Wow.
It is everyday people swiping up on their brokerage apps, driven entirely by hype and FOMO.
I have to play devil's advocate here, though.
Okay, good.
If Wall Street isn't involved, couldn't an optimist argue that this is actually a good thing? Because we always complain that institutions front-run the little guy, right?
Yeah.
So if retail traders are the only ones buying millions of shares today, aren't they just, I don't know, beating the suits to the ground floor of an undervalued company?
It's a very seductive narrative, and it's exactly what traders tell themselves when they buy a penny stock. The reality, however, is much darker. Institutional anchors don't just hold the price down, they stop it from free-falling. When a stock is entirely retail-owned, it becomes hyper-reactive.
Oh, I see. Like riding a jet ski in a hurricane.
Exactly. It's highly reactive and incredibly volatile. Without the deep pockets of institutional buyers stepping in during a dip, a sudden panic can cause the price to crater just as fast as it spiked.
Yeah, because retail traders are notorious for trading on headlines rather than fundamentals.
Right. And to understand why 90 million shares were bought today, you just have to look at the incredibly deceptive headline this company just put out.
Oh, you're talking about their fiscal year 2025 financial report.
Bingo.
Because if you glance at the income statement, Datavault looks like the next tech behemoth. Annual revenue jumped from $2.67 million in 2024 to $39.09 million in 2025.
Which is massive.
And almost all of that hit in Q4, with
Yep.
revenue coming in at $33.8 million. That is a 3,650% year-over-year growth rate for that quarter alone. Plus, they reported their first ever GAAP profitable quarter, squeaking out a $661,000 net profit.
Which is exactly the shiny object retail traders are meant to see.
Right.
You see, GAAP profitable means they didn't just use creative accounting to hide expenses. They actually made a legitimate profit under standard accounting rules for those 3 months. So if you are scrolling a forum and you see a headline screaming 3,650% growth in first GAAP profit, your instinct is to buy immediately before you miss the boat.
But then you read the very next line of the income statement.
Yeah.
Because if you pull back and look at the entire 12 months of 2025, that single profitable quarter is sitting on top of a massive crater.
A huge one.
Their annual net loss was a brutal negative $78.99 million. They lost nearly $80 million to generate $39 million in revenue. How does an AI tech company bleed that much capital?
Well, if we connect this to the bigger picture, it really comes down to the staggering cost of the infrastructure they're trying to build. Datavault is attempting to aggressively deploy what they call quantum-ready GPUs.
Which, by the way, sounds like a buzzword cocktail created in a lab specifically to trigger retail tech investors.
It really does. Yeah. But they were building massive, high-performance computing data centers.
Yes.
These aren't just, software engineers writing code in an office.
Right, it's physical.
Exactly.
Yeah.
This requires buying incredibly expensive physical hardware. Advanced graphics processing units designed to handle massive parallel processing for AI and cryptography.
Okay.
The capital expenditure required to buy, cool, and power thousands of these GPUs is astronomical. Add to that the crippling interest expenses on the debt they took out to finance this hardware, and you wind up with a trailing 12-month earnings per share of negative $0.52.
Ouch. So if they are bleeding cash that rapidly, how are they still operating?
This brings us to the balance sheet, which is honestly the most confusing part of this entire deep dive for me.
It's very deceptive.
Yeah, because if you look at their assets, they report $274.7 million in total assets against only $36.7 million in total liabilities.
Right.
Their debt-to-equity ratio is shockingly low at 4.6%.
Right.
That leaves them with $238 million in shareholder equity.
Right.
On paper, that looks like a fortress. It looks like a fortress until you realize the walls are made of depreciating silicon, and the treasury is completely empty.
What do you mean?
This is where we have to separate accounting theory from operational reality. Those $274 million in assets, that is almost entirely the physical GPU servers, the data center leases, and, perhaps intellectual property.
But they can't pay their employees with a GPU.
Exactly. This is the classic trap of a company that is asset rich but cash poor.
Right.
Having $274 million in tech infrastructure, but no liquid cash, is like owning a $10 million mansion, but having an overdrawn checking account. You might have a high net worth on paper, but you can't buy groceries, and the power company won't accept a brick from your house as payment.
That is a great analogy. And the grocery bill here is massive. The cash flow statement shows their cash flow from operations was a negative $23.6 million for the year.
Yep.
But their ending cash balance, the actual liquid money sitting in the bank as of December 31st, was a microscopic $2.0 million.
$2 million. That's it.
They are burning over $20 million a year, and they have $2 million left. The math simply stops making sense.
They are completely running on fumes.
Which sets up the most alarming contradiction we found in all the research today. Because if you are an executive at Datavault AI and you just delivered a quarter with 3,650% growth, and you genuinely believe this company is on the verge of taking over the AI space, you would expect those executives to be mortgaging their houses to buy up every share of their own stock.
Oh, you'd expect massive insider accumulation.
But we are seeing the exact opposite. Let's look at Wall Street analysts first. The consensus rating right now is a hesitant hold. The Maxim Group did maintain a buy rating, but they quietly took a knife to their price target, slashing it from $4 down to $3.
Lowering a price target by a full 25% while stubbornly keeping a buy rating is a classic Wall Street maneuver.
Yeah.
It is analyst speak for, we still have a relationship with this company or we still have to cover it favorably for our clients, but the underlying mechanics are rapidly deteriorating.
That makes total sense. But the analyst behavior is nothing compared to the internal executives. The most glaring red flag in the entire data set is the quiet unloading of shares by top insiders in late March 2026.
Yeah, that's huge.
This is just weeks before this massive retail pump today. If you just hit your first profitable quarter, why in the world are you quietly selling off your own stock right before retail investors jump in?
Because of information asymmetry.
Okay.
The retail traders matching the buy button today only see the 3,650% growth headline. The insiders selling the stock, though, they see the $2 million left in the bank account. They know exactly how many weeks of payroll they have left. When executives sell their personal shares into a retail-driven hype cycle, it suggests a profound lack of confidence in their own ability to navigate the upcoming liquidity crisis.
Are you saying they're using this retail frenzy, these 90 million shares being bought today, as a convenient exit door for themselves?
Right. It provides the perfect liquidity. Look at it this way. If an insider tries to sell a massive block of shares on a quiet Tuesday when only 1 million shares are trading, the price will instantly collapse.
Right.
But if they sell into a day where 90 million shares are changing hands, their sell orders are absorbed by the retail buying pressure without crashing the price. It is incredibly opportunistic.
That is entirely predatory. So, knowing all of this, let's lay out the ultimate debate for our listeners. Is Datavault AI a deeply undervalued gem that is just misunderstood by the market, or is it a masterfully disguised value trap? Make the bull case for me first. How does someone justify buying this today?
The bull case hinges entirely on forward-looking execution. Datavault isn't resting on his laurels. They are projecting $200 million in top-line revenue for 2026.
Wow. Okay.
Yeah, that would be a 400% jump from the year they just finished. To hit that, they just opened new quantum-ready GPU data centers in New York and Philadelphia.
And they do have new revenue streams coming online. They signed a reported $750 million in Q1 tokenization deals. And from what I understand, tokenization involves taking real-world assets like real estate or private equity and turning them into digital tokens on a blockchain to be traded fractionally. Datavault's AI infrastructure supposedly facilitates this, locking in $77 million in processing fees for them. That is real money on the table, assuming those contracts actually materialize.
And if they can deliver on those tokenization contracts and collect that $77 million in fees, the company transforms.
Right. The cash issue is solved.
Exactly. The $2 million cash problem disappears overnight, the debt becomes manageable, and that $274 million in server infrastructure starts generating pure profit. That is the bull case. They are right at the inflection point of scaling to a powerhouse.
But the bear case is heavy.
The bear case is structural gravity. Despite all those massive projections, their trailing 12-month free cash flow is negative $23.9 million. Their net profit margins over the last year are negative 202%. That means historically, for every dollar they earned, they spent $3 to get it. And because it's a high beta penny stock, meaning it's wildly sensitive to broader market swings, any delay in those tokenization fees will result in the stock violently correcting.
And this leads us to the ultimate trapdoor, I think. When a company has $2 million in cash, burns $23 million a year, and desperately needs to scale to survive, they have to get money from somewhere.
Yeah.
And we found out exactly where that money is coming from. Back in March, Datavault filed what's called a $1 billion mixed securities shelf offering. Explain how this shelf offering is essentially the executioner's axe for the retail traders buying today.
Think of a shelf offering like a company printing a giant stack of blank checks and leaving them sitting on a shelf in the CFO's office.
Okay.
Whenever the company is about to bounce a payroll check, they take one of those blank checks off the shelf, write a massive number on it, and create brand new shares of stock out of thin air. They sell these new shares into the open market to raise the cash they desperately need.
But creating new shares out of thin air deletes the value of every single share that already exists.
Exponentially. If you own 1% of this company today, and tomorrow they pull a check off the shelf and flood the market with millions of new shares to raise cash, your slice of the pie just got significantly smaller.
Right.
Your voting power drops, and the fundamental value of your shares is crushed. And remember, they have authorization to do this up to $1 billion worth.
Wait, if they only sell those new shares when they need to, wouldn't they want to sell them when the stock price is as high as possible?
Precisely.
So the 20% surge today, the 90 million shares bought by everyday retail traders, those retail traders aren't just buying the stock, they are providing the exact price spike the company needs to justify pulling a blank check off the shelf and diluting them?
The great irony of high-growth, cash-poor penny stocks is that the retail investors trying to get rich off the company are the exact product the company's consuming to stay alive. The stock surge isn't necessarily a reflection of inherent value. It is the creation of a fundraising mechanism.
That is a staggering realization. The hype is literally the fuel for their own dilution. So, given that dark cloud hanging over the stock, how do we view the immediate outlook versus the long-term reality?
Well, in the short term, pure momentum is a powerful, irrational force. If this retail frenzy holds its ground tomorrow and pushes past that heavy $1.85 resistance level, human emotion could easily drive a quick run up to the $1 psychological barrier.
Okay.
And if it breaks a Bollinger 1 set, it crosses that 200-day moving average, which could trigger algorithmic trading bots to start buying, adding fuel to the fire.
But if the volume dries up?
If the volume dries up and the retail hype moves on to the next shiny object, gravity takes over immediately. Without institutional buyers to catch the knife, a failure to hold the $1.80 line means a very painful, rapid retest of the $1.70 support level.
And long-term?
The survival of Datavault AI rests on a nearly impossible tightrope walk. They have to perfectly execute that $200 million revenue guidance and collect those tokenization fees, while simultaneously diluting the stock through that shelf, offering just enough to survive, but not so much that they completely destroy shareholder value.
So what we're really looking at is a race against the clock. Can the revenue from these massive new deals hit the bank account before the bank account literally hits zero?
That is the multi-million-dollar question.
And it leaves us with one final, very provocative thought to mull over. If Datavault actually signs $750 million in tokenization deals in the first quarter, deals that supposedly lock in $77 million in fees, why were the top executives quietly unloading their own shares just weeks later?
Yeah, it doesn't add up.
Do those insiders know something about the actual viability or the timeline of those contracts that the retail buyers pumping 90 million shares today have no clue about?
In a market driven entirely by information asymmetry, you always have to ask yourself who holds the clearest view of the future? The people buying the headlines or the people inside the building?
It makes you look at that 20% green candle today in a completely different light. Well, thank you for joining us on this deep dive into Datavault AI. We've laid out the financials, the mechanics of the dilution, and the insider mystery. Now it's your turn. Hit that like button, make sure you are subscribed so you don't miss our next analysis, and get into the comments right now. Is Datavault an undervalued powerhouse ready to change the AI landscape, or is it the ultimate retail value trap? Let us know, and we will see you next time.